Ahoy there, traders, and welcome back. Welcome back. How's everyone doing? Pop a yoo-hoo and ahoy hoy in the chat box and let me know how your week's been. Excellent, excellent. Hello, everyone. Awesome, Ruben. Hello. Hello, Anthony. 100 lines for you, Anthony. I will not go AWOL. Hello, Randall. Amy, how you doing? Can't figure this up and down market from Amy. You, me, and everyone else, Amy. You, me, and everyone else. I think this is where you raise an interesting point. I mean, for those who can't see the chat, everyone should be able to see the chats. And if you can't see what everyone else is commenting, I'll look into it. But it should be that you can say hello to everyone. But Amy raises an interesting comment. Can't figure this up-down market every other day. It's an interesting observation, but I think it raises some noteworthy comment or some noteworthy comments that are noteworthy. I don't know what the right way of saying it, but nonetheless, surely you get the sentiments. But the longer I've been doing this, the less and less I'm focusing on the minutiae of the up a day, down a day. And the hardest part about not paying attention to noise is firstly knowing what the noise is, but then also living through it on a day-to-day basis. And I'm not going to say I'm not impacted by all the bullshit that's going on. I'm just not as influenced as what I was 25 years ago. And it takes time to get there. And this is one of those, I've seen it before. It's not my first time sort of comments. But the more that you experience it, the more that you observe it. And I think it just emphasizes that the importance of having a filter, a lens, a strategy, an algorithm, a set of rules. We can call it a lot of different things in a lot of different ways, but it all amounts up to a definitive guide of how to view the markets so that you can sift through the noise and the nonsense and know when to stay out the markets as well as when to jump in the markets. And that kind of brings me full circle back to the primary focus. I do have a little bit of a theme that I'd like to underscore most things today, and that's trend trading done right. So that's what we're going to be focusing on later on. And this is obviously brought to you by the letter P and the number 45. No, it's not Sesame Street, Phil. It's brought to you by Production Line Trading. That's generally how I view things, is through that algorithm that I mentioned. And again, it's not something fancy, you know. It's, I mean, sure, I let people know and I teach people the mechanics of what I do, but the reality is I'm a trader first. I want this for me first. And it turns out that people keep asking me about it. It's why I do these sessions. Plus, I enjoy them. I am the type of person that likes to stop tourists to see if they need directions. And again, not everyone likes teaching other people. Again, I just get absolute pleasure from it. And think about it, it just makes perfect sense. You know, you do it once and sell it twice. You know, it is the very nature of being a trader. Anyway, with that said, the typical agenda that we have today is going to be, we're going to take a look at the markets. We're going to look at trend trading done right. And maybe we'll find some stocks to trade. And I don't think I've said hello to everyone. Let me just take a quick look at the attendee list because I did start just a few minutes later. Hello, Adrian. Not forgot about our chat later. If you hang around, we can sort out a time schedule. Anthony, obviously, Bal, Charles, Ian, hello, Ian, Perry, Peter. Lots of familiar faces. Rajesh, Randall, obviously, Rodrigo, Ruben, and obviously Scott. I thought you were going on a road trip, Scott. You snuck in for 10 minutes before you hit the road. So where are we? Oh, yeah. So if you are new, my name's Philip Newton. I've been trading, when I say trading full time, I made my career out of trading. which is awesome. I like to spend these days as little time as possible at the computer, unless it's by choice. And I'm here by choice, not because I have to be. So I love a good ramble. I love a good read. I like coffee. My mornings, I'm in the UK, so predominantly the first few hours of my day before the US markets open are rambling around, noodling around, generally working out, reading a book. And I also have a strange affinity to flamingos. I'm not embarrassed to say it, but there's just something about the little buggers that I quite like. As you probably gather, I'm not a Wall Street guru. I'm just a regular guy who figured a few things out. And I can give you the long sob story version of it maybe on another day, but I was housebound back in 2001. I was diagnosed with Crohn's disease initially. And hopefully this just influences, just kind of gives you a little bit of perspective on how I approach things. I mean, Crohn's disease is a very tiredness and fatiguing condition. And in my case, I've got permanent mild symptoms, so I get tired very quickly. It's almost like an on-off switch. I don't know when I get to be active or inactive, but I have to kind of live my life around that unknown quantity. And when I was diagnosed back in 2001, it was very severe, priest standing over me, giving me the last rites and all that nonsense. But it's, it kind of influenced the way that I do things. I had a very short window of time to pay the bills, keep the lights on, put food on the table. I was housebound. I couldn't do a regular job. I'd been trading on and off for several years, and it's what gave me the push to kind of go full time. I had no choice, and I still had bills to pay like everyone else. I took £1,000 or dollars, doesn't really matter, £1,000 off my credit card and savings, and in the next 8 months turned that into $92,500 and a bit of change and a few pennies. And from that day forward, I never looked back, but it was all done in a very small window of time. The strategy that I have today, it really encapsulates those early experiences. And now that I've got the luxury of time freedom to do other things, I like to spend time away from the computer. So, what do you want to do with your time? Is really what it comes down to. Again, I know some of you are highfalutin chief executive ding-dongs, and you've got important things to do. You've got the world to save, which is great. Some of you have got life. Some of you have got family. Some of you may be just generally busy with other commitments. Again, all I'm trying to illustrate is all our lives are different. And I choose to live my life this way. And that's the important thing. That's what trading has given me the freedom to do. These days, I refer to what I do as production line trading. And it should be like that. It should be step 1, step 2, step 3. We can identify the process, identify trading opportunities, visually confirm what we're looking for, and then we go and apply our trade management. It is simple to replicate. It's not that there are not a lot of moving parts. I always compare it to learning how to drive. When you first learned how to drive, it seemed complex. And it was just because there's a little bit of an initial steep learning curve. So I'm never going to blow wind in your sails to say that what I do is easy. My apologies. It's not that it's not easy. It's just that there's a little bit of a steep learning curve, just like when you were learning how to drive. And the complexities come in by our own devices. You don't need to know how the internal workings of a combustion engine works. I'm not that smart, but at the same time, we just need a rigid set of rules that we can replicate. And again, as I mentioned, as you probably alluded to from my brief backstory, is that I want it for me first. And it turns out that, it's good to replicate. And as you can see there, it's easy to follow unprofitable and extremely unprofitable. It gets results, and that's all that matters. Anyway, for the last 28 years, wow, that's a shocker. 20 years I've been helping traders get the results in just 20 minutes a day to make the leap to profitable trader in the next 90 days. That's pretty much what I'm focusing on right now, so that we can all have the freedoms that we expect. I've coached thousands of students, personally mentored, literally, hundreds, close to 1,000 students one-on-one with my programs. so that we can profit from swing trading stocks, create wealth, and generally live our best life. And what I try and do in these sessions is just to be your personal swing trading mentor, whether it be in a small way or a more formal way if you want to get more involved with my programs. So anyway, that's me. If you want to kind of have a quick scan down the laundry list of things that I've done over the years, the one thing that is universally true is that I am obsessed with helping traders replicate the type of success that I've been very fortunate and blessed to have. So let's just look through that lens that we mentioned earlier. The production line process, you can apply the tactical stuff, the Dow through, the Gann through, the Elliott wave theory, the widgets, the whiz bangs, the styles of charts, the day trading, the swing trading, the investing. You could pretty much put it into this process. And that's what a good process should do. We should be able to have a mechanical scan. This is the bit that means that we're not flicking through chart after chart like a mindless zombie, hoping to find that the next chart is the one. Again, we've all done it. I've spent time doing it. But when I had this realization for myself, it was, I should just be able to zero in on the best stocks today and not worry about everything else. Again, we're going to look at that later on. We usually look at it most weeks, but then we also want to visually confirm. We're going to spend more time on this step this week, the visual confirmation elements. I've pretty much moved away from trying to recognize every possible chart pattern. I was more of a visual trader, chart pattern trader for most of my, certainly the early part of my career. I spent 12 years just trading breakouts, for example. But we can categorize them. And at one point, I was trading 34 different named patterns. And what I started doing is not worry about the pattern, it's just worry about the phase of the market, that the 6 money making blueprints, as I refer to them. And the best way of thinking about it is it's a river of money. When we look at the charts, it's not just that it's a trend or a pattern. We're trying to identify where's the money flow. A literal river of money is creating a trend. People are prepared to pay an ever increasing higher price for a stock, a commodity, and instruments. That is the very definition of an uptrend. So that's what we aim to do in the visual confirmation. Like, which way is the river of money, so that I can go with the flow of that money and hopefully profit in some small way. We don't want to get caught in the going against the currents. We want to try and avoid the eddies, to stick with the water metaphor. But hopefully it just illustrates the point. When you know what the trend is, it makes everything else easier, because you're not going against the grain. And sometimes what I'll say is, when you get that, you can accidentally make money, because you're going with the flow of money. So even by accident, even if we mistime our entries, which I do frequently, I always say to my students, like, I'm always going to be early, but I'll never be late. And that's the trick of this. It's just to recognize the overall flow, the river of money. Anyway, and the most important part is actually the trade craft, the entries, the exits, the stops, the targets, and all the trade management in the middle. And what I've started doing a lot recently is think more like a hedge fund. Again, I manage my trading funds. I had a little over 10 million assets under management at one point. So by fund standards, really small. But I was trying to think about, like, what is the very definition of a hedge fund. It's to be completely agnostic to direction. It doesn't matter where the stock's going, up, down, sideways, doesn't matter what the market's doing. We should be able to profit from either side of the market, meaning that we have this hedge. And we're in this little bit of a unique situation at the moment where there's only long trades. So it's a little bit more important to think about the in-trade management. But we've got this wonderful and very simplistic rule set that I used to use when I was when I was intentionally hedging positions off at the entry points. And it's kind of important that we do that now. Now, when we get back to some sort of two-sided market, which we're not seeing at the moment, and that means that we've got a natural flow of bullish trading opportunities and a natural flow of bearish trading opportunities. And as you can appreciate, we've just come out of a crash. So, everything that could go down, that has gone down, has gone down. So the line of least resistance at the moment is up. Now, everything will come back into sync And what that means from a portfolio trader point of view, which is what I teach, is that we're going to have a natural tendency to see some bullish trades and some bearish trades. And just the natural course of the way that the market or a portfolio ebbs and flows back and forth, as we were describing, there's going to be some bullish money flow and some bearish money flow as stocks go into and out of favor and into and out of up and down trends. And we've just got to be a little bit more conscious of that right now. Because of a long-only portfolio, it means that I want crash protection, I want hedge protection, I need to think about corrective trade management, and a little bit more than I would have to gain at a portfolio level. So I've just got to think about these things at an individual level. It sounds like there's a lot of work involved, but it quite literally is, has it met a conditional trigger, which I know where all these points are before the trade is placed. So that I'm going to place my entry, there's my trade management trigger, there's my target level, there's my corrective trade management trigger, which is the posh way of saying it's not going out, I need to start fixing it. And a lot of the time we can actually make money even if the trade doesn't work out. So yes, if your trade idea doesn't work, you can still make money. And that is what hedge funds do. They're agnostic to being right or wrong. It's just managing the risk and making money. And again, that's what I teach all of my traders. So with that said, that's the lens that I look through and try to introduce you to every week. But let's just focus on trend trading done right. Trend trading done right. What does that mean? What does that mean? One of the things that I sometimes laugh and joke about is when we see on social media or even just the regular media, and they're going, buy the dip, baby, buy the dip. What does the dip actually mean? What is a buying opportunity? Is it just because a market, a stock, an instrument, a currency, whatever the thing is that we're looking at, is it dipping? Just because we see a downward movement doesn't mean that it's a buyable dip. And I think that's a very important distinction to make. And I know probably everyone here today is nodding the head, of course, yeah, of course. A horse is a horse, of course. But the most people tend to forget about it as soon as they start thinking about their own money. Conceptually, it makes sense to a lot of people. So just some questions before we dig into the charts. Not that one, that was from last week. Okay, so the first thing is should I buy the dip? We were talking about, buying the dip. If price is selling off, we're seeing price, red bar, like we've seen the last, 4 or 5 days, it's a downward movement. And just because we're seeing a downward movement doesn't necessarily mean that we should be buying the dip, for a profitable and resumption of an upward movement. We've got to keep looking left across the charts to be able to recognize the prior uptrend and the context of the charts to be able to say, is this a dip? So it's not a case of should I buy the dip? Is this a dip in the context of a trend? And I think that when you understand the trend, again, as we mentioned a moment ago, the best way to think about the trend, it is a river of money. That uptrend, that bullish movement, it's money. If we imagined it like a genuine river, the flow of money is going up. People are prepared to pay ever increasing higher prices as prices continue to move higher. It's still good value. Prices going up. That is the money flow. So do we really want to go against the flow? Do we want to take a chance and try and swim against the flow, the river of money? And that's the best way of thinking about this. So what we're looking for is not a case of should I buy the dip? Is there a dip in the context of the trend, the river of money? And that's what we want to try and identify. So what is the trend? Naturally, that is what we're going to be looking at. It is the 6 money-making blueprints helps me the 3 trends that there are help me identify 6 ways of making money. So first thing that we might want to consider is what's the time frame. And I would say that this question is actually misleading in that whether we're looking at a 5-minute chart, a 15-minute chart, a 60-minute chart, you can see where I'm going with this, a 4-hour chart, a daily chart, a monthly chart, a yearly, whatever the time frame on the chart is. And most of the stuff that we do here every week is on a daily chart. But regardless of what the time frame is, we need to look at enough data. So I would say don't worry about the time frame as a means to identify the trend. And I think that what a lot of people do, or the mistake that people make, is by asking what the time frame is that it suggests that you're going to apply a top-down approach. So what that means is you might start off with the daily, then you might drop down to the 60-minute charts, and maybe then drop onto the 5-minute charts, or you might go, weekly, daily to identify swing trade opportunities, or maybe you go monthly, weekly, daily. You're going to drop down timeframes. Now, personally, I think this is absolute bollocks. It really is utter nonsense. And I think that if you can just recognize the trend in the way that I'm going to show you, then top-down analysis becomes absolute rubbish. It's unnecessary, because what a lot of people do is they don't look at enough data to be able to recognize a trend on any time frame. So that's why they often will do this top-down approach. So I would rather restate the question instead of worrying about the time frame and drop-down analysis and looking at multiple time frames, because what you'll find is on different time frames, there's different trends. On a 5-minute chart, you can see a downtrend, which is a retracement on a 60-minute chart, which might be in an uptrend, which might be a retracement in the concept of a daily downtrend. You're going to see different trends on different time frames. So let's take the confusion out and stop asking this silly question. Let's make it easy for ourselves. And also, if you're doing top-down analysis, it does mean that you're doing the thing that I hate, which is flicking through chart after chart, hoping to find the one, hoping to find the needle in a haystack. Why don't we just zero in on the best opportunities right now? So a better way of saying what is the or not necessarily what is the trend, how do we determine the trend, is what's your time horizon? And what I mean by that is if you're looking at a daily chart, you need to look at enough data to be able to determine the trend. And I normally suggest you want to be looking at about 300 candles, 300 days, 300 bars, and it doesn't then matter what the time frame is. If you look at enough data, you can contextually look for the trend on that time frame. And that means that you can do a one time frame strategy, which is what I'm a big fan of. So if your entry time frame is the same as your analysis time frame, then you need to look at enough data. So if you want to trade a 5-minute chart, that's cool. Like I do it. I have done it. I'm not doing it right now as I want to spend more time away from the computer. But if you want to look at a 5-minute chart, make sure that you're looking at 300 or so bars. And the more, the better, because it's going to give you context to be able to evaluate the trend so that you can find a proper and correct entry that is going to give you a profitable edge. And that profitable edge is to go with the money flow, but it's the money flow relative to the time horizon. So does that last part make sense? That's what I wanted to ultimately finish on. The money flow relative to the time horizon. So then that doesn't matter what the time frames. And you can, more importantly, you can do this one time frame. If you want to trade a daily chart, just look at a daily chart. If you want to trade monthly, look at a monthly. If you want to trade 60-minute charts, look at a 60-minute charts. Best way of thinking about it is which is the right time frame, is how much time do you have available? If you've only got 10 minutes in the day to look at trading opportunities, then you're only going to be looking at a daily chart. Looking at a 60-minute chart, it makes no sense whatsoever because you've not physically got the time to evaluate. And similarly, if you've only got time once or twice a week, then it's still going to be a daily chart, but maybe you go to the weekly chart to give yourself that flexibility. Another consideration you might want to do is which is the best time frame for you to trade and the best time horizon in combination with that is when do you want to get paid? Do you want to get paid at the end of the day, the week, the month, the year? If you want to get paid at the end of the year, maybe you're more into an investing approach. If you want to get paid at the end of the day, it's going to be a day trading strategy. But if you've not got the time to day trade, then it's absolutely pointless you trying to fit a square peg into a round hole and day trade to get paid at the end of the day because you don't have time to do it. So think practically when you're thinking about these things, back into the right solution for your situation. So if you want to get paid at the end of the week, maybe you go, usually, well, let's do that now. Actually, let's do that. If you want to get paid at the end of the week, then the 60-minute chart would make sense. 30, 60-minute charts. If you want to get paid at the end of the day, again, you can still do that on a 60, but your entry time frame is going to be 5 minutes. If you want to get paid at the end of the month, and that's normally where I sit, I'm probably going to be on a daily chart and nothing else. So that should just give you a little bit of a framework to see where you land. And then if you've not got time to day trade, well, I'd like to get paid at the end of the week, but I don't have time to look at intraday charts. Similarly, I want to get paid at the end of the day, but I don't have time to do it. Well, that leaves you with practically a daily chart and get paid at the end of the month. Now, you might still get paid at the end of 5 days. The strategies that you can apply on a daily chart that are a little bit more faster acting. But then let's think about life. We want to do other things with our life and not be sat in front of the computer, zoning out, flicking through chart after chart, having loved ones nag at you to saying, why are you at the computer again? Take the trash out, the kids need feeding. all those things that we have life. So think practically about these things, because there's nothing worse than missing the trade that you were looking at anyway. You were looking for a trading opportunity. You have got the strategy, you're on a 60-minute chart, but it's just not practical for you to trade it for, because life, you've got the day job, you've got family, you've got other commitments. You don't want to do it passively. And I think I would rather take every trade that sets up knowing that I'm not missing anything than try and fit that square peg in a round hole and day trade when I've not really got time to do it, and then end up missing opportunities, because that missed opportunity, the opportunity cost, if you like, of trading passively but not committed to it is and can be a lot worse in my mind. And that's when it becomes this trading's a scam. It's all bullshit. It's nonsense. It's not. It's just that you're applying it in a way that doesn't make sense for your situation. So does that resonate, folks? Those last final thoughts, did that land true? Did that hit home? Just some practical advice that certainly I've learned the hard way over many, many years. Awesome. Thanks for your comments. Right, let's think about the trend. So what most people do is, even though you might have a lot of data loaded, as you just saw me with, most people, and you'll never do this because you're now aware of it, will just focus on the last portion, the last few days, maybe even just the last 2 or 3 days. In fact, let's just do that. Let's zoom in. So if we were looking at that part of the charts, and again, bear in mind, you might have the whole chart full of data as you just saw, but your eyes are drawn to the right-hand side of the charts. So even though you've got the data loaded, you're just looking at the last 3 or 4 days. Maybe you're just even looking at the last day, the live bar. Firstly, you want to ignore the live bar, especially if you're on a daily, on any time frame. Just ignore the live bar. It's live. It's going to change. It's dynamic. It will move. It will evolve. And we want to make decisions, consistent decisions based off the completed information. And if I can actually turn the live bar off, I think I would, so ignore the live bar is a great piece of advice here. But then what most people do is they're just looking at the last few bars, few days, few hours, whatever the time frame is. We're on a daily chart. So they're looking at the last few days and they'll go, oh, this is a consolidation. It's relative to the time frame. But do we have enough data to be able to make a sensible trading decision? Not on this time frame, we don't. Now, we could ultimately trade different timeframes, but as we've suggested, we don't want to do that. We don't want to hop around. Again, a big novice mistake. And I'm using that word. I don't normally like calling novices, but a big novice mistake, huge, is jumping around from chart to chart, from time frame to time frame. And what we want is consistency and simplicity. Now you're aware of this, and I know you all know this now. So you'll never do it. You'll never fall into the trap of doing it. You see me doing it. All we're doing is trading one time frame. So what most people do is they look at not enough information and they don't consider the trend. Or maybe they're looking at a little bit of data and they go, oh, we're in a downtrend, sell the rally. Really? Sell the rally? We need context. So this is what I keep saying. We're looking at this. It might be, it's a kind of neutral, a little bit up, a little bit down, undertones. Again, note the wording, a little bit up, a little bit down. There's no real conviction with my assessment of the trend. And we need to look at enough data. And some people might think that this is enough, and you could say buy the dip. But again, we want to look at enough data to make an evaluation. So the time horizon that we have is critical, it is important. So this view right now, it's a little over 12 months. So we'll go into, you can see December 2020. Obviously, we're not there right now. So it's almost 12 months. So that is going to be about 300 bars. So on a daily chart, it's going to be 8 to 12 months. 8 to 12 months. Well, it's going to be over 12 months, actually. It's going to be at least 8 to 12 months on a daily chart. And this is going to give you enough data on the time horizon, TH for time horizon. It's going to give you enough data on the time horizon to make a sensible evaluation, because now what we know is the river of money. The river of money is up. Now, note the wording. It's a statement. It's not a question. I'm not asking you. It is up. Does that make sense? That is a question. And this is simple. There's one or two comments about, oh, this is basic, Phil. Get onto the good stuff. Like, I've been doing this since the mid-90s, and I've complexed my trading. I've done all the weird shit under the sun. And the reality is that the one thing that works, the one thing that makes money is trading the trend. I don't create the trend. I'm not a big enough player in this market. And I don't need to worry about making a trend. I just need to know what money is moving and creating a trend. And I'm not trying to pick a top. I'm not trying to pick a bottom. I'm just trying to profit from the money flow. So now that we know what the money flow is, we're looking for a little bit of a back eddy, to stick with the metaphor. We're looking for a dip, because now I've got context to the trend. And what we normally do is, for anyone who's been with me for any length of time in these free sessions, is to say, we've got the 200 period moving average, we've got the 50 period moving average, and we've also got the 20. So what I can say is, if the money flow, visually, it's going up. The average prices, they're all stacked on top of each other, so they're all going up. Great. This is a perfect trend for us. So what I can start saying is when price comes below the 20 or below the 50, let's just stay with the 50 for now, just for simplicity's sake. So there's the 200 and there's the 50 period moving average. So we're going up. That's the river of money. So when price comes back to the 50, that's going to be my buyable dip. And if it's retracing, or there's a red candle like here, like here, like here, like here, like here, but it's not at the 50 period moving average, then I can just call that noise. It's noise. I'm looking for a buyable dip in the context of the river of money. And I don't think I can say it any simpler than that. So all the times that price comes back to the 50 are back eddy or retest or dip in the context of an uptrend are buyable dips. And we're almost there now on the right now. We said last week, we said the week before, we said the last few weeks, actually, we can see price come down to 4,400. and still be in context with the trend. So when or if price gets there, 4,400, I think, wasn't there a TV series about the 4,400? Does anyone remember that? Am I dating myself? I think it was good. As I remember, it was pretty good. I think there was the 4,400. But it's a buyable dip in the context of a trend. And again, I'm looking back at the comments. This is basic, Phil. I get it. But this is what's made me money over the last 28 years. That's it, nothing else. If I die today and you just apply this before you do anything, before you do anything else, before you apply anything fancy, anything creative, entry mechanisms, the 34 patterns that I mentioned earlier, Dow 3, GAN 3, elliott wave theory, blah, 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 some sort of fractal pattern. None of it matters without context. And I think this is and this is why I talk about it every week, but this is the single biggest error that new and experienced traders make, is to not look at the context of the charts. Make it easy for yourself. If you're going to go on a long driving journey, are you going to drive with the traffic that is going in the same direction as everyone else, or are you going to drive on the opposite side of the road and take your chances? Are you going to take your chances? So I want to go with the flow. Interesting question from Amy. How do you know it won't go to 43? You don't. Let me just say that again. So Amy's asking a good question, really good question. How do you know it won't go to 4,300 or lower? We don't know. Now, don't mistake me for saying when it gets to 4,400, I'm going to automatically buy. I didn't say that. I'm saying I'm going to be interested in being a buyer at the 50-period moving average, which is approximately 4,400. I'm not saying I'm automatically buying at that point, because that would be silly. Because you're absolutely right in that. Let me zoom in just so you can see this. There we go. That should be easier. Now, what we don't know, and this is the hard part with trading, it's close to the 50-period moving average. So there's our 50. It's close to the 50-period moving average. So our buy point is a little bit above 4,400. Let's just say it is 4,400 just to keep the numbers simple. So we're waiting for price to come back to this, or to touch or be at or near. There's lots of ways of doing it, but we're waiting for it just to kiss the 50-period moving average. So it's not there. Now, I'm not saying I'm going to buy it automatically when or if it touches, like it did back here, like it did back there. It came close there. So I'm not saying it's an automatic buy. What I am saying is when it gets there, I'm going to look for an entry condition. Does that make sense? I'm going to look for an entry condition. Now, I've not spoken about an entry condition yet, because if you remember where's my slide deck? Let me just get it up. Ta-da. Let's put it into context. All we're doing for the moment is we're presuming that we've scanned for something and we're looking at a chart. All we're doing is the visual confirmation. Like, which way is the money flow? It's going up. Great. Wait for a dip in the context of an uptrend. So I'm waiting for my point on the chart, which is the 50-period moving average. When it gets there, it's not close, it's not near, it's when it is there. I will then be interested in looking for an entry. That's when I can go over to the step 3. Tradecraft, look for my entries, my exits, my stops, my targets. That's it. So all we're doing for the moment is recognizing, is there an opportunity, and when is my opportunity? Does that make sense? And it's because of that comment that you made there, Amy. I don't know, and no one knows. I'm never going to try and blow wind in anyone's sails to say that I know exactly what's going to happen tomorrow. Now, don't get me wrong. I've got a really good idea because I've seen things unfold many times over the last 20 years. So I've got a good handle on what might happen next. But the truth is, I generally don't know what's going to happen tomorrow. But the probability of something similar happening again is exceptionally high, because that's the trend. That's the river of money. You know, now if you want to, when price gets to the 50-period moving average, and then it turns around and goes back above the 20-period moving average, you could certainly do that. That would be a nice mechanical, easy to execute entry condition. Again, we can do that on this occasion because the 20 and the 50 and the 20, they're relatively close together. Again, I haven't really got much time left to go into exact entries and exits. I've spoken about them on other Friday workshops. So if you want to go back on YouTube and have a look back through some of the workshops, if you want help with a more detailed, robust trading strategy, I do help and mentor people. I have group trainings. We go through this twice a week, looking for entries, exits, stops, and targets, and I explain all of this in my program. So if you need more help, just know it's available. But if you want just a nice simplistic approach, again, it goes down to the 50. As soon as it goes back above the 20, it did that there. So yeah, you would initially use a stop loss because it went lower. So went to the 50 again, back above the 20, go long. And you can pretty much stay long for however long it takes for you to get to targets. Again, so it rallies, retraces back to the 50, buy above the 20, stop loss below the lows. Again, just giving you a nice mechanical, use the average prices to assist, comes down to the 50, goes back above the 20, stops below the lows. Targets are a multiple of risk if you want to do that. Back to the 50, back to the 20, enter above the 20, stops below the lows, rallies, comes to almost the 50, back above the 20, rallies. You know, you've got 2 or 3 trades this year just with a very basic interpretation of the trend here. Again, there's more to it than that, as you can appreciate, but just to give you a quick guide as to when you would enter. So it's retracing to an interesting location. When it turns around, when it's given a predetermined trigger to get me into the trade, then that's when I will execute my trade and go long at that point. I'll be in the trade. Stops can go past the lows. I usually trade with stock options because then I don't necessarily have to worry about where my stop loss is. So I can enter here, sit through that, and profit, you know, on the way up. So I don't have to worry about my on exit risk management. I can use a stock option and my risk is managed on the entry. If options are brand new for you, the best way of thinking about them right now is it's just like a deposit. I appreciate it's not entirely accurate, but it's as good as. The worst thing that can happen is you lose your deposit when you buy a stock option. So buying the dip, the trend and context is important. And this is what I'm looking for when I'm looking for trading opportunities, trading setups. And if we just go down to some of my charts here now. So let's make sure that we've got enough data. So if you want to just focus on some of the best performing stocks, these are my, as I lovingly call them, my massive gainers, super duper ding dongs. These are stocks that have back tested through my algorithm, the automated version of the strategy that I've just guided you through. I thought, let me just flip that on for you. So what this does, this looks for not just any trend. It looks for super duper ding dong trends. It looks for exceptionally strong momentum based trends. And what this is doing is it's looking back over the last 20 years, and this is Apple for reference. And you can see, so the study here is looking back over the last 20 years and say, when price is above the 20, above the 200, above the 50, above the 20, so 200, 50, 20, when it's all those 3 conditions are met, go long. Shazam. So in the last 20 years, if we had placed our first trade on $1,000, again, the number doesn't matter. You know, you can do 100, you can do $1, you can do 500, you know, whatever your risk profile is. But this is per trade. So the point is this is not compounded. It's just $1,000 in, and every trade for the last 20 years without compounding. That's what would have happened. So hopefully what you're seeing is you don't necessarily have to take my word for it that this is it's just the river of money. Oh yeah, it's a fancy, gimmicky way of describing it. Like, here's the proof right here. You don't have to take my word for it. Like, there's the strategy performance. It's a steady equity curve. We've got back-tested data. I've got my actual trades over the last 20 years. What computers have allowed me to do is to validate all my the way that I have traded over the last 20 years, and not just validate it, but just to say it's not just trade the trend is not just a fancy thing that's mentioned in all the textbooks. It is a legitimate way of trading. It is a legitimate river of money. So when you put $1,000 in, you get $44,000 out. So just imagine what that would have been like with compounding. 52% of the trades are winning trades. Cool. Now, this is trading stock. This is trading signal to signal. And what that means is when you get an entry condition, so for example, when the average prices are crossed up and those three conditions are met, that's great. And when it comes back here, so below the moving averages, then it's going to close the trade. So it's signal to signal. It's the worst version of any strategy. So I know as soon as I apply money management, this equity curve is going to be steeper. That's the wonderful thing about this. So this is the worst version of the strategy. And what it means is it hopefully just explains the comment that I mentioned earlier. You can put the trade on and accidentally make money just because you're going with the flow, going with the river of money, all the metaphors that we mentioned earlier. And you've got the probability of success in your favor. Again, ADS, I like this one. This is a good strategy. I had a little bit of a wobble here. Again, I know with money management, I can correct that. I know with my hedge fund management process, I know that I can turn that into a profitable routine. So that's what I mean by with money management. I can turn a lot of the equity dips on individual stocks. I can turn them around quite nicely. This is BBWI. This is actually what used to be L Brands. So they've just split the company up a little bit, but it's still got a lot of trade history. So this is, again, it's a good performing stock. It's a solid company. It's a boring stock. It's been going since 1999. Again, you put $1,000 in, you're going to get $18,000 out. Looking at it, I could possibly even just ignore the short trades and don't worry about them. But even so, you've got 45% of the trades, even if you take long and short, almost 45% of the trades are winning trades. So again, it should give you the confidence to say, you know what, trend trading works. Now, it doesn't work on every stock. I've got to say that. We want liquid stocks. We want stocks that have a track record, have a tendency to trend well, that have a tendency to move and ebb and flow. And that's what this list of stocks is. These list of stocks here are like stocks that I've pre-filtered. I've gone through and ran the report. It takes a bit of time, as you can appreciate, and just worked out, like, is this a good stock? Does it trend historically? Well, if it does, then there's a really good chance that the next trade that I place, again, this is Hershey's, make money from chocolates. The next trade that I place, the chances of it being a successful trade are exceptionally high. Again, I can put $1,000 in over the last 20 years, get 19,500 out. I should be winning 43% of the time. It's great. That gives me confidence to place a trade. So anyway, come back to the point. If you want a list of stocks that are proven to work, you can quite literally plug into the portfolio there. You don't need to look at every stock every day, all of the time. And we've got to start somewhere. So if you just want to look at the best candidates, so that if you are a little bit pressed for time, then, and you don't have the fancy scanners and the software like I do, which I appreciate it's not for everyone, and some people are on Mac and all that stuff. But what it means is if you've got, well, these are the best, these are the top 25 stocks. If you were to go through them one at a time and you're looking for the trend, like this is Boeing, I don't see a trend here. We can skip over that until we get a a very definable trend, that the same sort of characteristics that we look at every week. What it means is if you need to kind of manually scan for opportunities, which is BBWI, we looked at this last week. We actually found this as a live trade when we scanned using the watch list. But if you don't have the luxury of a watch list and all the fancy software, you can go through what are quite literally some of the best stocks and look for that river of money. This is CLF. Now, I think it'd be fairly easy to say that we've got a very clear trend. It is going up, but it's now below the 50-period moving average. So what we'd be waiting for is to go back above, say, $24, somewhere around there. So when or if that happens, then I can get in the trade. And if it doesn't happen and keeps retracing, which was your comment, Amy, then I'm not placing a trade aimlessly. But if it does get me in and stop me out, or it does get me in, then I can have corrective trade management. If you're trading stock, you can use a stop loss. If you're using options, your price of the option is fixed. The worst that can happen is you lose your deposit. You can close the trade if you want. And what I'm hopefully highlighting is that it doesn't take long to recognize, like, hell yes, there's the trade. Domino's Pizza, buy the dip. Great, that looks awesome. Halliburton looks a bit of a mess. Leave it alone. HFC, it's doing a bit of a hodgepodge. Let's leave it alone. Hershey's, we've just looked at it. There is the trend. It's a statement. Now you know what the trend looks like relative to the time horizon, because that's what we're looking at, 12 months, about 300 plus bars. Relative to the time horizon, it is going up. Fact. That doesn't matter now whether it's your first day, your first week, your first month, whether we're doing this 10 years, 20 years. If you just do that, what is the trend? Which way is the money flow? Then it's going to increase your chances of success. As I've just proven for you, you can quite literally stack the odds in your favor just by knowing what the trend is. You're not placing aimless trades that have, you're buying a downward movement thinking it was a dip. And the reality is you could be looking at something like Alibaba, BAB, Alibaba. It's in a downtrend. Sell the rally. So you might be looking at this chart. And if you are, or if you have looked at this chart and you're thinking to yourself, Alibaba is, I like Alibaba. It's selling off. There's the dip. Buy the dip, baby. And it might go up. You might get lucky. But the reality is the money flow, the river of money is down. So sell the rally, which is what I've done just a few days ago, as you can see there. Would I have bought Hershey's? Let's go back to Hershey's. HSY. Would I have bought Hershey's during the bounces off the 20 on the big rally? You can do. Again, just for simplicity, Perry, I've just said, let's focus on the 20, the 200 and the 50. So rather than just give an either or explanation, I've just said, let's use the 50, let's use the 200 just to keep it simple. But you're absolutely right. If you want to be a little bit more aggressive, you can add in the 20 period as well. So as price rallies and retraces to the 20, you can certainly do that. And that's pretty much what got me into that trade there. Again, I'm already in this. It's not really going very far, very fast. It's not hit trade management triggers. It's not hit targets. It's a little bit frustrating. That's just the way it goes. They don't all work out. All I can do is play the numbers. In fact, let's look at the numbers on this. Let's go back to the algorithm. And I think this is a good teaching point here. I'm in a trade. It's not quite working in the way that I'd like it to, because we all want a trade that hits the ground running and makes me buckets load of cash. We all want that. But the reality is that maybe I'm just in that down phase of the strategy, because all strategies have downward phases, just like a stock chart. You can see it's dipping and ebbing and flowing as we were describing. So maybe this is just one of the ones that just doesn't work out. And I've got to be okay with that. It's not about being right. It's about playing the numbers. The numbers say that 43% of the time, I should be making money. Now, I can apply money management. I've applied some trade management on this, and it's going to mitigate losses if it was to sell off further. But the reality is that maybe this is just one of the ones that it's not meant to work out. I've got to have an acceptable risk for that trade. So can we buy the 20-period moving average? Of course we can, yeah. Can we buy the 50-period moving average? Yeah, of course we can. For the moment, this looks like it might be selling off down to 200. That's okay. I'm okay with that. I'd like that to happen now because I've applied corrective trade management. So I'd like a deeper retracement. I'd like this trade to not work out because I'll make more money if it doesn't work out now because of the trade management practices that I approach trading with, the hedge fund element. So going back to your question, can we buy the 20-period? Of course you can, yeah. If you want to be a little bit more adventurous, I don't think aggressive is the right term, but certainly adventurous would apply here. Again, Jeffries, again, I've had multiple trades on this. It's going up by the dip, easy peasy, by the dip. I'm sure we can all get the process. I'm going to go through them very quickly. Now, here's the thing. The trend has changed. So we have got the trend. It is going up, but using our frame of reference, we're now below the 200-period moving average. Let's not worry about it. Let's not worry about that at all. Something new is developing. Leave it alone. But when you know what the flow and the river of money is doing, it means that you can look at the charts and go, oh, there's my trade right there. Oh, there's my trade right there. You know, leave that one alone. There's my trade right there. Buy the dip, Starbucks. SCN, again, trade on. It's not working out. I've applied corrective trade management. I should make money when this goes down. Cool. It's not about being right. It's about mitigating the risk. So actually, with the way this is working out, again, we went through this in real time. Good teaching points. Again, I'd love it to get back to $60, but you know what? It's not. I've applied some corrective trade management here. All my insiders will know what I've done. But if this was to sell off, I would love that to happen. It is selling off. So if this carries on going because of the corrective trade management that I've applied, I'll hopefully make more money by being wrong and applying my hedge fund management process to a trade that's not working out. So if this was to sell off hard and fast, I'd really like that to happen. So being wrong is usually a good thing because sometimes, not all the time, sometimes I can make more money by being wrong than my original trade idea. Going up, buy the dip. Going up, buy the dip. Going down, leave it alone. Going up, buy the dip. Oh, it's below the 200, leave it alone. VLO, it's below the 200, leave it alone. Looks a bit messy, looks a bit sloppy. WCC, it's going up, buy the dip. X, it's a little bit sloppy, a little bit messy, leave it alone. It's below the 50. It's still a buyable dip. If it was to move higher, then we can have a new entry. But do you see how long it took to go through that? When you've got a structure and a framework to evaluate the trend, it doesn't take that long, even if you have to go through manually and inspect the top 25 stocks. So when you've got the best stocks, the best opportunities, your trading universe can be quite small. Now, mine is less than 100 stocks. There are 100 of the best stocks. But if you want to just keep it nice and tight and just trade the cream of the crop, take a screenshot. They're your best stocks. What do I think about Starbucks? Firstly, Amy, I hate their coffee. It's trash. What do we think about Starbucks, the stock? I don't know. It's just too bitter. It really is. You know what? I was reading a little bit something about coffee. And for the big chain stores, and I didn't know this, but it makes sense now that I know. It's one of those things, oh, of course. Now that I know it, it's no, of course, it's true. But to get the consistency of the flavor of the big chain coffee brands, I didn't know that they actually burn their beans. Like they don't just bake. I knew they've got to bake the beans, but it's like they burn the beans to give. And this is why a lot of the chain stores, they've got sour or bitter tasting coffee because it's burnt coffee that would. I never knew that, but I don't like the big chain coffee anyway. So. Yeah, they think exactly. You're drinking shit coffee, and you can tell that you can taste the difference when you get a local blend. And I'm not particularly a coffee snob, but it's just one of those. Oh shit! Yeah, that's why I don't. Maybe that's why I don't like it. It's just anyway. Moving on, Phil. We don't want to hear about my coffee exploits. I do like my morning coffee, as you can gather. Yeah, absolutely, Randall. It's lifestyle. They've done it right, from a branding point of view. Anyway, Starbucks. So back to the question. What do we think about the stock? Let's go through our process. Visually, we've got our river of money. Cool beans, if you'll pardon the pun. Now, what I'm looking at here is we've got 20s cross the 50 once, 20s cross the 50 twice, 20s cross the 50 three times. I'm giving you a little bonus tip before we go off, but this is a way that we can start saying, maybe, although it has been trending, maybe temporarily, this is in a short-term consolidation. So maybe I can just think about putting a little bit of a box around Starbucks and saying, you know what, I'm not sure. Let's just say we've got a temporary consolidation. Now, what that means is if I say that range low here, if I'm going to call that the range low, maybe I can say that $110 is my range low. So this comes back to a couple of weeks ago when we went through the money-making patterns. Price can go up, price can go down, price can go sideways. So we've just recognized that price is possibly in a short term, and it's saying it's short term because it's not lasting for 12 months. As we were just saying, we're looking back over 12 months. We've got what we might refer to now as a half and half chart. The left half is up, the right half is in an early stage consolidation because our average prices have crossed. So if this is ranging or in a consolidation, there are now 4 ways that I can make money. I can buy range lows. I can sell range highs. I can buy the break of range highs, or I can sell the break of range lows and profit from downward movement. They're the 4 other money-making patterns that we go through. So because price is in this wonderful uptrend previously, then I can presume that trend will continue as long as price stays above the 200 period moving average. Now, rather conveniently, the 200 period moving average is at the range low. So I can start thinking about, where's my little drawing tool? I can start thinking about this by the range low pattern over here. So when or if price comes down to approximately $110, I'll be calling that in context, the short term, the range low. So I can apply an entry criteria that I look for there and be a buyer at 110. So if I'm looking for a brand new trade right now, it's a wait situation, and this is what I'm waiting for. Amy, if you want to use $113, use $113. I honestly don't care one way or the other. So Amy I'm being rather flippant with my answer. I'm being flippant intentionally. So Amy was just commenting on, I thought $113 was support. I don't care. Think of it like a zone. If it makes you happy, call it 113. I don't care about the pennies. I don't even care about the dollars. About $110 is good enough. Why 110? Because that's exactly where the 200 period is. That's where this support is here. That's where that support is. And if you want to call it 113, call it 113. If that makes you happy, do that. I honestly don't care one way or the other. Pick your level on the charts that makes sense to you. So rather flippant answer, and I was intentionally doing it, so don't take it personally. It's just the way that I view things these days. It's not about being right. And I think the sooner that you can let go about being right, this is the analysis as I see it at this moment. And I'm less focused on if it gets to exactly $113.23, then I'll be a buyer. I don't care about that anymore. It shouldn't matter to anyone. Should not matter. I think if you can focus less on timing with precision and entry, think about it like this. We've got it's like having a dartboard. When you start to give yourself absolute specifics to take action or inaction, it's like trying to hit the bullseye on a dartboard. I'm guessing everyone's familiar with a dartboard. It's like having, these concentric rings. It's like trying to hit the bullseye on the dartboard. I don't need to worry about hitting the bullseye. I just want to hit the targets. I don't care about if I get the bullseye, I'm going to be really happy because I'm human like everyone else. But if I can just hit the board, that's more important That is more important to me. Hitting the board, getting on the scoreboard, making some money is more important to me than being right these days. Now, again, I've got to add in, I am human. I love being right. I'm going to brag like everyone else when I am right, but it's just not that important to me. Making money is more important, and following my strategy is more important than hitting the bullseye and going, look at me, I hit the bullseye. It doesn't fucking matter. It really doesn't. On paper, absolutely. Yeah, Randall said in shooting sports, they call that being on the paper. Yeah, just hit the target. You know, if you can hit the target, you're better than 80% of the rest of the traders who try, again, doing the bunny fingers behind the scene. Now, here's an example of me not taking my own advice. Does everyone remember me talking about Netflix several weeks ago? And I was saying, I'm going to wait for $500. And guess what? It never fucking got there. I was looking for a bullseye trigger to take action. When it gets to $500, I'm going to be a smug little prick. I'm going to thump my chest. So I've relearned this lesson recently. And we all do it. We're human. We're going to do it like at some point. Like I've done it recently. I'm going to do it in the future. I'll do it again next month. We're all going to do it. But I think you've got to recognize when you are doing it, it's time to take a break, take a step back. It's not about being right, being exactly at $500 is what I kept saying. I'm going to wait $500. I'm going to wait $500. I'm going to wait $500. And if I just focused on the fact that the range low, and we've been talking about this all year. So this is one of the stocks that we've been following as a kind of the open sessions. You know, we've been pinging this off the range highs, the range lows for multiple months. We've had multiple trades on this. And I said to myself, I'm going to wait for $500. I was trying to hit the bullseye with my entry. Whereas what I should have been doing is saying, you know what, close enough is close enough. We've got a really vague zone of support. So that's, and I've got it marked off. Yeah, I've not changed these. You can go back and check the recordings from multiple months ago. But we've got this zone on the targets. This zone of support. It's not an exact support, but I wanted to be smart. I wanted to be clever. I wanted to stroke my own ego. And I'm very happy and open and fully prepared to admit I dropped the ball because I was trying to be too specific. And again, it's a lesson that I try and teach all my students, and I relearned it for myself recently. So think about support and resistance more as zones. It's more important that we recognize the phase of trend. And as Anthony just said, yeah, it's still in a brand new phase. So I've missed the first leg. I've missed the breakout move, but you know what? That's okay. Okay, as Tony just said there. It's guess what it's doing? It's coming back to the 20-period moving average. It's a breakout. It's a pullback. It's going from ranging sideways to a breakout trade. So it's not that I'm going to never trade Netflix again. Oh, bloody hell, I've missed a trade. I'm going to get in like blah, blah, blah. Whatever conversation we have with ourselves, it's like, okay, now it's doing something new. I've missed my mark. You know what? I've nailed this multiple times this year. I've made a lot of money on Netflix going sideways. Now it's breaking out. I'm hopefully going to be making a lot of money as it starts to trend. So we've got a breakout, we've got a pullback, it's back to the 20. We can be buying or be looking to buy when it meets entry conditions. Yeah. Again, Amy's one of those, Amy, BYND. Again, another one that's not working out. Again, we looked at it last week. When it was mentioned, I can't remember who mentioned it last week. Adrian, was it you asking me about it last week? Again, it's not working out. That's okay. But the support on BYND it is kind of a zone. It's this that's kind of throwing a fly in the ointment. But we can say that is a specific level. Now, it's not working out for the moment. It doesn't mean that my trade idea is wrong. But I've got to have trade management triggers in place to say, you know what, when those triggers are reached, I'm going to start applying corrective trade management. And what that means to me is that trade idea was initially bullish. And what I can start doing is being a little bit more proactive on my trade And what the professionals would talk about, or the way it's normally phrased in hedge funds, is you're going to start trading around the position. You can still do this at the end of the day. It doesn't mean dropping down to a 5-minute chart and scalping it like an idiot. I can be a little bit more proactive with the management briefly for 1 or 2 weeks and be a little bit more aggressive with my trading around the position to mitigate the risk. Now, we can do this at the start of the trade and be a little bit more active doing that straight away. But I like to be a little bit more passive. So I like to have a trigger to go, you know what? It's not quite working out in the way that I'm expecting. That's what this red box is. So I know full well it's not quite working out the way that I expected, but that's okay. I've got a trade management process that says, you know what, if it hits the next phase of that trade management process, I'm going to start being a little bit more proactive briefly so that I can turn that trade around from a monetary loss to a monetary gain. And that's what trading is. It's not about being right on direction. It'd be great to be right. You'd probably see an email from me saying, you know, there's another one that worked out. But the reality is it's the managing of the risk is what we will do more frequently. DDD is a good example. I actually wanted to try and I didn't have the time to do it, but this is a good example of, again, another trade that it didn't work out from the point of view of it didn't trend. Again, we've got a nice 3D systems, great stock, has the tendency to ebb and flow and move quite exponentially. I was thinking we might see a move back up to $50 earlier this year. We went through the entry at the time. So you can see the trade management that I'm applying. I'm going long and short on this trade as per rigid, strict rules. So I'm not doing it willy-nilly. It's like, oh, the trigger's been met, manage the trade. And that's what this is. You know, we've got multiple trades. I've made more money with this stock not going to $50 by applying trade management. I've actually, I think I've made 3 times as more money by applying trade management rules and trading around the position doing that hedge fund management process that I mentioned, because it didn't go to targets than I have done if I just let it go to targets. And I think that's an important distinction to make. You know, this is what trading is. It's not about being right. It's about managing the risk. And a big part of that, to bring it full circle, is determining what the trend is. What is the trend? Let's come back to the opener, S&P. So about managing the risk, determine the trend. The trend's going to keep you on the right side of most of your decisions, but then they don't always work out the way that we want. So this is why we have trade management. At its most basic, the most basic thing that you can do is use a stop loss. A stop loss, when the trade is proven to not work the way that you expect, you can close the trade and you can stop the bleeding. And most traders don't do that. I mean, you see it on cryptocurrencies all the time. And I appreciate we've gone a little bit over, but these are like throwaway comments. These are probably some of the most important lessons that you can have just with these throwaway comments. You see it on crypto. Crypto traders become crypto investors when their trade is 40% underwater. You know, their trade is lost 35, 40, 50% of the value from when they entered their trade idea. So they turn themselves from a crypto trader to a crypto investor, and they close their eyes for the next 6 months, hoping to make the money back. And that's a really sad way of trading. That just tells me that they've not got a system, a process, a strategy. They've not got clear rules on what they're doing, when they're doing, why they're doing it. And the fact that you're asking all these questions, you know, should we have a trade management trigger? Should we have a stop loss level? You need to know those before you place the trade so that you're not making it up as you go through your trading routine, your trading process. And we want clear take action triggers. We've gone through most of them today. You know, when price gets to a level of interest, a line in the sand, and the simplest, most mechanical way that I teach all my traders is, let's just use the moving averages. Now, you'll move on from them in the future with time, with experience. You'll layer on other things, more discretionary interpretations. It's not necessary, but it will happen in the future because that's what experience does. But at its most basic, you know, 28 years later, I've come full circle. I just want it simple. I don't want to draw trend lines. I don't want to draw Fibonacci. I don't want to look at where Dow theory, Gann theory, Elliott wave. I don't want to know any of that stuff. I mean, I do know it. I can apply it, but you know, it's so subjective, and it all changes depending on when you start the wave counts and all that nonsense. So let's just keep it simple. Move an average, trade the trend, look for the river of money, and you know, just surf the wave, surf that river of money. Folks, I think I've kept your attention for far longer than I planned. But as always, thank you for your time and attention. We've gone through, we didn't focus on mechanical scan this week. We looked at that most weeks. We focused a lot more today on visual confirmation. Like, what does the trend look like? What does the trend look like? And we touched a little bit on tradecraft, entries, exits, entries and exits as opposed to targets. But all of this was to circle around trading the trend done right. If you do nothing else, if you take, for any of the long-term viewers here, if you do nothing else other than apply the what is the trend question before you do anything else, before you apply anyone's strategy, whether it's my strategy or someone else's strategy, just make sure that you apply the trend and recognize what phase the market is in. And if you're applying trending strategies, you need a trending market. If you see a ranging market, as we described earlier, then maybe you just want to step on the sidelines for a while, because your trending strategy won't work because the market or the instrument or the chart that you're looking at is not trending. So if you'd like a little bit more help, one or two of you have been asking about in the comments. Anthony, thank you very much for your kind words. Rodrigo, Randall, of course. Amy, thank you for your kind words. If you would like a little bit more help, I do offer help and support. I'll give you a 2-minute version of what I do. Right now, I'm focused on group mentorship, a group program. I do offer one-on-one training. My time is finite, as you may appreciate. But if you'd like some more help, if you want to know the specifics of the entries, the exits, stop to targets, the trader management, you want to know what I'm trading, when I'm trading, why I'm trading it, I will quite literally spill the beans on everything. As you can appreciate, these free sessions are free. I can only go through a limited amount of information. But basically, you get to look over my shoulder Monday and Wednesday, in addition to these open sessions on a Friday. We get to kind of go through the strategy outline. We have a quick start blueprints. It just says, here's everything that you need to do. It's a checklist. We also get a checklist, a handy printable desktop decision map that goes through all the things that we spoke about today and a whole lot more to say, this is the decision that I'm trying to make. Check, check, check. It is like a pre-flight checklist. I have a full details of the hedge fund management system. As we said, it's the real secret to success. This can even turn your trade ideas that don't work out. Technically, they're wrong. I don't like using that word. But it can turn a monetary loss into a profit. And that's a wonderful place to be. You get to see what I'm trading every day, entries, stops, and targets, so that you can see all the portfolio adjustments along the way, so that you can learn by demonstration. Without any benefit of hindsight, you get to see what I'm doing, you get to see how I'm doing it, so that you can apply it for yourself. You can plug and play into my portfolio the most profitable stocks with the most profitable patterns that I trade every day. We've also recently introduced prop shop trading. It's accelerated results. This is the fastest way to turn knowledge into repeatable trading. This is what we used to do in the hedge funds to teach our traders in the fastest and smartest possible way. We used to get them to apply this process. That's what I do with all of my traders in the group training. And of course, you get unlimited support. When you need it, you got it. That's it, folks. That is my invitation for you to work with me. And if you'd like to take the next step, I don't know if what I do is right for you, but if you are I'm looking for 2 or 3 motivated traders who are ready to start getting results. And if that is you, then you can either email me or go to the main website, AntiVestor.com, fill in, put your email in. You'll be taken to a short video that explains a little bit more. Or if you'd like to actually talk to me direct, you can just email me at phil@antivestor.com. AntiVestor.com. Just go to the main website. So that's it, folks. Thank you for letting me talk at you for an hour and 20 minutes. I do enjoy these sessions. Thank you for the interactions. It does make the sessions much better. It helps guide the conversation when you're asking questions or being interactive. So thank you very much. And if you'd like to learn more about production line trading and how you can accelerate your trading results, you can start getting trading results. I was talking to a gentleman last week, and he'd been at it trying to figure it out alone for over 20 years. 20 years he's been a break-even trader. Just let that sink in for a moment. For over 20 years, he's been trying to make it work. Most people spend 3 to 5 years trying to figure it out on their own and then give up. And it's really sad because the chances are that you've got all the knowledge that you need to make it work, but you just need to have it structured in a way that makes sense. So if you want to talk about it, send me a message. We can have a chat. At the very least, I'll point you off in the right direction, because maybe what I do isn't right for you, and I'm okay with that. But at the very least, I can point you off in the right direction. And if it is right for you, then we can talk about that a little bit more. Oh, I've just noticed last week, Randall said some lovely comments. One of my new students who's seen some great successes. So if anyone's on the fence, contact Randall. If you have any questions, comments, observations, if you're thinking about the things, best way to contact me is, although you can email me, my Slack community, you can just click on my name and send me a direct message if you so choose to. That's what most people do. It pushes to my mobile phone. And that's how I keep in touch with all my lovely and adoring traders. Thank you again for your time, for your attention. Thank you to everyone who stayed right to the end. Adrian, Alex, Anthony, Ian, John, Perry, Rajesh, Ruben, Vito, Scott's on a road trip. He had to leave early. YBT, I'm not sure, but they're your initials, Zach and Zeke. You could be name buddies. Thank you, everyone, for spending an hour and a half out of your week. We could all be doing other things, but nevertheless, thank you for spending it with me on a Friday morning. Have a great weekend, and I'll see you at the same time, same place next week.